Hello and welcome to this programme for Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's investment trusts. My name is Danielle Levy and today I'll be talking to Roderick Snell, co-manager of the Pacific Horizon Investment Trust, about how he runs the portfolio. He will then answer your questions, which you can submit at any time via the Q&A box. Well, first things first, Pacific Horizon's share price performance has been very strong over 1 and 3 years. What's driven performance?
Asia itself has performed very well. The portfolio has, thankfully performed as we would hope in such an environment. Now, over 1 year, there have been 3 key drivers. The first and most important has been technology and AI, and that's come from a few areas, including Korea, where our memory names like Samsung and Hynix perform very well, up 3 or 4-fold year to date. Our Taiwanese tech hardware has also done very well. Companies like Chroma, which does semi-testing, and Acton, which does switches for data centers. And then we've also done very well in a number of tech IPOs, especially in China, where Baillie Gifford's reputation and long-term time horizons meant we've tended to get industry-leading allocations to those IPOs. So companies like Knowledge Atlas, also known as Zhipu. This is a Chinese large language model that we invested in at the IPO. That's up 9-fold since then. And likewise for a company called Minimax, which is also a large language model, that's about 5 times since the IPO. Secondly, at the other end of the spectrum, a number of our cyclical companies have also performed very well. For example, our mining companies, especially copper and gold, including MMG and Xinjiang. And then thirdly, our underweight to India has been our third largest contributor. Now, 3 years has also looked actually pretty similar in that our tech names and those cyclical businesses have done very well. The main difference is that India is actually the largest contributor over 3 years. It was our largest overweight back then, and a number of the small and mid-cap names in particular did very well. But we also reduced India pretty dramatically. So it went from our largest overweight to our biggest underweight over the past couple of years. And as India underperformed, that also helped us. So a big overweight where we made a lot of money in India and then reduced it and did very well as India underperformed. Really helped those 3-year numbers.
See the most compelling growth opportunities in Asia?
Sure, I'll probably highlight 3 areas, and I'm sure we can go into more detail later. The first would be AI technology. Without North Asia, there is simply no global AI. Korea and Taiwan sit at the very center of the global semi and AI supply chains. And it's very interesting. I was recently in the US, and the debate there is very much whether AI will make money. In Asia, it's how much. And that's because Asian companies really are the key picks and shovels sitting at the critical bottlenecks. And they really don't care who wins the AI race. They just supply the critical infrastructure to everyone. Second area I'd highlight would just be China. Over the past 7 years, China has spent trillions de-westernizing its supply chains by redirecting capital from its property market to its industrial base. Now, the West has really focused on the bust that created in China, which was a brutal and severe property crash, which really decimated consumer sentiment and equity markets. But they're missing what really China built through that pain, which is a world-class industrial superpower. If you just look at cars, 5 years ago, China didn't really export any cars. Today, it's the largest exporter in the world. And then the final area I'd highlight would be sort of raw materials and the physical economy. The West desperately wants to reshore, but much of the physical economy now sits in emerging markets in Asia. Copper, rare earths, batteries, chips. These are really treated as low-value activities for decades. Now we're discovering that they're strategic, scarce, and very hard to rebuild. But the problem is, look at rare earths, where China dominates processing, or copper, where all the key assets are in emerging markets or Asia. And that's really why, for the first time in my career, many Asian companies have real pricing power. They're no longer just fighting to be the world's lowest cost producer. And in many cases, they only produce the things the world desperately needs. So I'd say Asia and EMs are starting to fuel the world. So they would probably be the 3 broad areas I'd highlight of key interest over the next five years.
And we've seen higher energy results as a result of the conflict in the Middle East. I mean, are you concerned that higher fuel prices could ultimately undermine growth in Asia?
Sure. I mean, the first observation I have, which is actually that Asia has been very resilient through this. We haven't had any issues to date, but certainly the longer this goes on, there will be impacts, and they will be quite different across Asia. So if you start with North Asia, actually China, Korea, Taiwan, I think are fine. China actually probably does very well out of this. They've got huge oil reserves, the most diverse energy mix in the world, and actually the lowest cost of energy. So I think they're a relative winner. Whereas Korea and Taiwan, they do import, but they've got huge external surpluses and can really cushion any economic blow. At the other end, you've got India and ASEAN, and they will be the worst impacted. India is the third largest oil importer, and most of these countries don't have significant economic buffers. Now, our portfolio should actually perform reasonably well in that India is our biggest underweight position, and we haven't got big positions in ASEAN outside of Vietnam. But I think for us, the key question is actually looking forward and saying, where are the opportunities? I think, for example, one of the most obvious ones over the next 3-4 years is energy security. So I think oil probably does quite well if people look to restock. Green technology probably has a huge catalyst here. So we've been adding to companies like CATL, CATL, the largest battery maker in the world. And also just the general infrastructure build-up we're going to see as countries want to have their own refineries, petrochemical firms. So we've been adding to a number of Korean engineering companies like Samsung Engineering as well.
And the US and China have continued to decouple over the past 8 years. Where do you feel we are in this process, and what does it mean for investors?
Sure. Well, look, I don't think these tensions go away. I think it's the natural state of affairs of two superpowers, an incumbent and one rising. So they will, continue to grind away each other. But for now, I think we have reached a kind of stalemate, if you like. If you take tariffs, the US tried to impose draconian tariffs on China, and China effectively stood up for itself and matched those tariffs, and then used the leverage of rare earths, and ultimately the US backed down. So I think we're in this tit for tat that will flare up occasionally and settle down, and that's going to be the situation for the foreseeable future. Again, I think the question for us is in many ways, what are the opportunities through this? Now, as an example, Washington has discovered that tariffs are a bit of a double-edged sword. You can slow a rival's catch-up, but at the same time, you actually incentivize and spur innovation. And that's exactly what we've seen in China, where the country has done everything it can do to de-Westernize its supply chains and become self-sufficient. And these areas where China wants to be self-sufficient are fully aligned with the Chinese state. And that's often a great place to be in terms of investments. So we've invested in several areas such as green technology, batteries, CATL as I mentioned, semiconductors. We recently took positions in a company called Cambricon, which is a bit like the NVIDIA of China, and also added to robotics names like Sanwa, all very much aligned with China trying to become self-sufficient. So ultimately, frictions remain, but I think that actually creates quite a lot of bottom-up stock ideas.
And you have a quarter of the portfolio in semiconductor companies and those companies that make semiconductor equipment. Why are you so bullish on the sector?
Sure. Look, I think it comes back to that point I made earlier that Asian semiconductor companies, sit at the very center of the global semi and AI supply chains. They are the key picks and shovels, at the critical bottlenecks, and they really don't care who wins the AI race. They supply the critical infrastructure to everyone. So if you take TSMC in Taiwan, it is the only foundry in the world that can make the most advanced AI chips. No TSMC, there's no NVIDIA. Samsung and Hynix in Korea, they dominate high bandwidth memory, which is probably the most acute bottleneck in AI today. GPU speeds are about 60,000 times this decade, memory less than 100 times. So GPUs are actually idle most of the time because you can't get enough memory. That's why Hynix is sold out of memory for the next 2 years and counting. And these companies aren't just growing. They're making record returns and huge profits. You'd probably be surprised if I told you the company likely to generate the biggest profits in the world this year is actually Samsung Electronics. And finally, these companies are actually relatively cheap, probably around half the multiples you pay for similar businesses in the US or Europe.
And if we look at TSMC specifically, which accounts for 13% of the portfolio, firstly, what's your outlook for the stock? And secondly, do you think that the company can continue on the same growth trajectory?
Look, TSMC is I think, a very unusual company because it sits at the center of almost every important technological trend. AI, smartphones, high performance computing. The simple point is this, if you want the most advanced chips in the world, there is only one place you can go, TSMC. And what's striking is that growth is not fading. It's actually accelerating, even as the company gets bigger. The company grew very strongly last year, and it's actually guiding to about 30% growth this year, and is planning to spend more than $50 billion expanding capacity. And despite that supply coming on, supply is still the bottleneck. Everyone still wants more capacity at TSMC. Now, I think TSMC could probably double its leading edge capacity and still fill it several times over. So the constraint really is how quickly TSMC chooses to add capacity while preserving returns. So they're being extremely disciplined and actually rationing supply. So yeah, the stock's done very well, and semiconductors will always be cyclical, but this is a rare kind of growth company. It's got world-class technology, customers queuing up, and management largely control how fast it wants to grow.
And over the past year, the team increased exposure to China. What was the rationale there?
Yeah, so we've been adding to China really for the past couple of years, mostly out of India. I think the key top-down reason, as well as having some great bottom-up ideas, is that China has gone from being probably the emerging market's biggest drag to potentially its biggest tailwind. To understand why, you've probably got to go back to 2018, when the US restricted semiconductors to China and the trade war really began. Now that clearly panicked China, and its response was to de-Westernize its industrial base. And as I mentioned earlier, they did that by taking China's huge domestic savings and shifting them away from property into industry. Now that drove two massive deflationary forces. First, a brutal property crash, and secondly, a massive surge in industrial capacity. Now the world was very much fixated on the bust. And fair enough, China took a huge amount of pain. Property prices falling 30 to 50%, and equity and consumer markets being crushed. But what I think people have missed is what China built through that pain, which is a world industrial leader. And it's across industries, batteries, solar, robotics, data infrastructure. China hasn't just caught up, with the West. In many cases, it's actually leapfrogged and become the best in the world. So I'd say that at great cost, China won the trade war. And now, crucially, policy is shifting back towards the domestic economy. They're clearly putting a floor under housing, stimulating the economy, and supporting the stock market. And finally, there's also the RMB, the currency. For years, China wanted it weak to support exporters. But if the priority is now the domestic economy, we want a stronger currency. And that's exactly what we're starting to see. The RMB has been strengthening for several months, and I think that is the start of a major policy shift. So, putting it all together, the world is really focused on what broke in China, but is missing what China built through that pain, which is an industrial superpower. And with policy now shifting back towards the domestic market and the currency, the backdrop for China really does look very bullish.
And Samsung Electronics, which is the second largest holding in the portfolio, it's experienced a turnaround over the past 12 months. It'd be good to hear what your outlook is for the business.
Yeah, I think it's very positive. Samsung is the world's leading memory producer, which is an industry that we certainly like for the reasons we touched on earlier. It's also changed a lot. 10 years ago, this was a terrible industry, computer memory. There were dozens of players. Everyone made losses, apart from Samsung. But now it's an oligopoly, just 3 players, and very disciplined. So you've got vast demand for AI at the moment. But again, a bit like TSMC, no supply really coming on. Samsung and Hynix, 2 biggest players, they're combined adding only about 10% of capacity. The industry would like 10 times that. They would like capacity to double for the whole industry. And we're just not seeing that supply response. I suppose the question, why Samsung within that memory space? Well, firstly, it's the cheapest of the memory players. And secondly, I'd say it's got the most options. Samsung is also the world's number 2 foundry. It competes with TSMC. It's invested over $100 billion into that business. It's still loss-making, but the world is desperate for a second source, and Samsung is the likely place for that. And it's also got a fantastic smartphone business. And as AI moves from the cloud and onto the edge or onto devices, Samsung is well placed for that. So it's the only company in the world that does memory, foundry, and devices. And as that all converges into one, who's going to be the winner in that space over 5 to 10 years? I think it could well be Samsung.
And you have around 9% of the portfolio metals and mining stocks. Can you talk us through the outlook for the sector? It's obviously been quite positive recently.
Yeah, no, it's been a good contributor to performance and quite different from our tech holdings. I'd stress it's very much concentrated in two areas, which is copper and gold. And the long-term case for copper, I think, is quite simple. Demand tends to grow with GDP, while it is likely to accelerate as the world wants to electrify, and copper is the metal that makes electrification work. We will need it in power grids, EVs, renewables, batteries. All of those need a lot more copper. So decent supply demand outlook. But again, it's the supply side that's extremely constrained. The world has underinvested in copper for decades, and today a new mine will take probably 15 years from discovery to production. So even if the world suddenly wakes up to the shortage, those tons do not arrive quickly. And existing mines are not easy either. Escondida, the world's largest copper mine in the world, is spending billions a year just to maintain current production levels. So demand is rising, but supply is not. So we see significant deficits in the coming years, and that's a powerful setup for copper prices. And for the right copper companies, the operating leverage could be very significant. Gold, similarities to copper. I think there's limited supply and potentially very significant demand. And even at current spot prices, gold companies at the moment are generating more free cash flow than ever before and paying it out in dividends or buybacks. And could prices go higher? Well, in a portfolio context, Western countries keep increasing their debts, printing money, and behaving in an unorthodox economic manner, then I think gold could continue to do very well over the coming decade.
And you touched on it earlier, where you mentioned that you've reduced exposure to India and shifted some of that towards China. What was the thinking of reducing the India exposure?
Yes, I mean, India's gone from our biggest overweight 2-3 years ago to our biggest underweight today. No big macro concerns really with India. I think generally speaking, the macro situation has looked reasonable. That said, it does face significant headwinds from the Middle East issues and rising oil prices. It is probably the most exposed of the large economies in the region to that. So that would be a headwind. And also, one question mark has been a lot of the growth for India has come through the public capex cycle. The hope has always been that the private capex cycle will take over, and we're not yet seeing signs of that. But outside of those issues, I think the macro looks broadly fine for India. The big concern for us, and I think other managers will probably be saying similar things, it is valuations. Just really struggling to find bottom-up ideas, even with the market having corrected. When I look at consumer goods companies, I was looking at one of the largest supermarket D-Mart supermarket chains in India. You're paying about 100 times P multiples for that business, and it's growing about 10% in dollar terms per year. You look at companies doing the same in China or Vietnam, and they'll be on a 10 times P multiple. So you're just seeing huge discrepancies of what you can get across Asia. And we really see that across most of the companies that we look at within the country. I think it's also interesting that India probably benefited 2 or 3 years ago from just vast amounts of liquidity looking for a growth story. China was in the doldrums, South Korea and Taiwan didn't have the AI story, and more broadly in emerging markets, we weren't seeing LATAM doing very well. So lots of flows are just going into India. But as Korea and Taiwan started to do well, China has started to rebound from its bottom, and other parts of emerging markets are picking up. We've seen a lot of those flows come out of India, and it's not clear to me why they necessarily go back to get valuations where they were previously.
And it'd be good to touch on the reforms that are happening in Vietnam. I mean, how significant are they for investors, and are there any companies or sectors that stand to benefit?
Yes, I think the long term macro story for Vietnam looks great, and it was our biggest overweight position for quite some time, and we've been invested for a decade. That was really originally on the export manufacturing side, where Vietnam was doing better than anyone else, and that continues to be very strong. The big change, as you say, are the policies that have come through, and that's because the domestic economy had been actually really quite weak in Vietnam. The previous general secretary who ran the country, a man called Trung, I've described him a few times as a miserable Marxist. He really wasn't interested in the economy, and he put in this very severe corruption clampdown called Operation Blazing Furnace, and it really brought the country to a standstill. People just weren't signing things off, and things were pretty slow and getting a little bit tricky, in fact. But he died last year, and a man called To Lam came in to replace him. And he's turned out to be the complete opposite. He's very much pro-business and pro the economy. So he wants, or has put in place, a 10% GDP growth target, arguably the fastest of any of the economies that we look at in Asia, all the emerging markets. And they've started with really reforms that we haven't seen in the past 40 years in the country. They've reduced the number of civil servants by about 200,000 to 300,000. It's unheard of in a communist country. They've halved the number of provinces. They're doubling infrastructure spending. And crucially, things are just getting done. I was there back in March, and you're genuinely seeing, previously when I'd been there, you speak to multinationals, you set up export plants. They were actually really worried about energy and electricity blackouts and whether they could continue with their factories working. You don't hear that anymore. Everything is very much up and running. That said, it's pretty worth highlighting that we have actually significantly reduced our Vietnamese position. We've probably halved it since I was out there in March. And that has a little bit more on those macro concerns. The Middle East issues. Vietnam is vulnerable to that. They do require imports of fuel. Inflation is already high, and they don't really have any financial buffers. It's also, a frontier market. It does have some liquidity issues. The banks have been running with loan to deposit ratios well over 100%, and debt levels are high. So it is more vulnerable to a weaker external environment. So given that, we have reduced our position after having done pretty well over the past couple of years.
That's interesting. It'd be good also to talk about tariffs. It's been over a year since Donald Trump's Liberation Day tariff announcements. What impact have these tariffs had on your portfolio and Asia as a whole?
I'm going to say probably actually ultimately not that much. I think we said a year ago that probably no low-end manufacturing was really going to leave Southeast Asia. The example I was talking about was that if you wanted to move the iPhone from parts of ASEAN and China to the US, it probably result in the phone costing at least 100% more for US consumers. And if you wanted to move the entire value chain over parts, etc., you're probably talking about 200 to 300% more. And that just seemed very unlikely to us. And indeed, we haven't really seen that low-end manufacturing move at all. If anything, exports from China and Vietnam have actually continued to grow. So certainly at the lower end, not much. I think the impact will be more in the US with inflation figures and a bit of pressure on the consumer. North Asia was always the one that was possibly more vulnerable, the higher tech space, because wages aren't such an important part of the equation. But again, these businesses, the likes of TSMC, they have gone and put some factories abroad into the US, but they've come from a very strong position. They've got almost monopoly positions, many of them. The US is desperate for the capacity to go in, so they've gone in with very strong bargaining positions. So in many cases, they've got very good subsidies. They haven't had to put their leading technology in, and still much of it remains in Asia. So ultimately, I think the ultimate answer is not a huge amount at the moment.
And you've described Asia's growth story as entering a new phase. Good to hear a bit more about this and the potential opportunities that you see.
Sure. Look, I think the big picture is that that there are some the top down looks pretty good ultimately for Asia at the moment. Markets are relatively cheap. We had outflows every year for the past 12 years across the region. Nearly all global fund managers are underweight Asia and EM more broadly, and you're paying record low multiples or record discounts to developed markets despite faster growth. And that's combined with the macro looking very good. Asia's had a very challenging backdrop for a decade. You've had the strongest dollar in 40 years and the most aggressive rate tightening cycle in a generation. But Asia's done all right through that. And if that happened at any other time in the past 30 years, we would have had an Asian financial crisis. And the reason that hasn't happened is because Asia's actually operating in an orthodox manner. We haven't done money printing, we haven't done quantitative easing. So actually on nearly all metrics, Asia is more resilient than it's ever been. It has faced two big headwinds that stopped it doing well. China and the dollar, but I'd argue both of those are starting to turn. As discussed, I think China's looking pretty decent. And if the dollar does continue weakening over the next few years, that's a major catalyst for the region. So I think top down, things are turning from being difficult to actually looking like a major tailwind for the region. And then secondly, I think that the Asian growth story is changing perhaps quite profoundly. For a long time, investors have thought about Asia mainly as a story of cheap labor and exports. Now, those things still certainly matter, but the most interesting story is now that Asia is moving from being the world's factory to becoming the world's innovation and industrial platform. You see that in areas that we discussed, like semiconductors in Taiwan and Korea, EVs and batteries in China, even digital platforms in India and Southeast Asia. So the region has scale, engineering talent, huge domestic markets, and in many cases, much lower cost structures than the West. And that creates opportunities not just in the obvious tech companies, but in the industrial enablers behind them. So I think the important point is it's no longer just a catch-up story. In some areas, Asia is now really setting the pace.
And finally, are there any companies that are currently flying under the radar where you're particularly excited about their prospects over the next decade?
Yeah, I suppose the obvious ones there might be in our unlisted companies. We've got a few private businesses within the portfolio, and they tend to be less well known by the market. So our biggest one of those is ByteDance, which is the owner of TikTok, the short form video app. And also Douyin, which is the China version that they have for the domestic market. And this is just a fantastic business. They've got $2 to $3 billion users, $2 to $3 billion users worldwide, and the financials are fantastic. This is a company that probably made around $50 billion of profit last year. That's effectively all cash. And that's with the domestic. That's with the international business actually not making any money at the moment. So there's huge potential here. They're still growing 30% a year. And we've got it valued at about $450 billion at the moment. That's on about just a 10 times P multiple for a business growing 30% plus. If we look at the number 2 listed player in China, Kuaishou, that would be on a 15 or 20 total. So it's very easy to see that this should be worth a lot more than it is now. And with some of the issues seemingly getting resolved with the US over TikTok, that business will hopefully be able to list at some point over the next couple of years, and we'll see that valuation really start to come through. So that's probably the most obvious one I'd highlight. I also think China domestically still looks very underowned and very cheap. Businesses like Haidilao or Luckin Coffee that we own growing nicely, but in some cases low single-digit P multiples. And then finally, commodities. We discussed them earlier, the copper names and the gold names. I still think these are hugely underowned in most funds. And on a 5 or 10 year view, I think will be some of the best performers globally.
Well, thanks, Roderick. We've had quite a few questions coming in from our audience, so let's start our Q&A. So the first question is on geopolitical risk. So the question says, it seems that geopolitical risk is an increasing consideration in global markets. How does the trust quantify and hedge risk associated with China and Taiwan, given the success of your positions in TSMC and MediaTek? Quite a big question.
Well, I think I'd start. Yeah, Well, I think I start by saying that geopolitical concerns have always been around in Asia and the broader emerging markets. So they're really nothing new to us, and it's something we've always paid significant attention to. So I think the first thing is just being well resourced and knowing the markets very well. We're fortunate here at Bailey Gifford that we've got an emerging markets team that's been investing in Asia since 1989. So a lot of experience, and we've done this before and seen a lot of these issues, similar issues in the past. And we've also built up a lot of contacts and resources over the past 4 decades in the region. So I think we have a decent insight into what we think is going on. For Taiwan and China, specifically, we've done a lot of work on this over the past few years and continue to monitor it carefully. For what it's worth, I think any significant military action by China on Taiwan in the next 5 years is very unlikely. But tensions will continue to arise around the issue. Yes, that has impacts on the Taiwanese businesses, and I suppose it's a bit of a binary event. Something significant happens, that is going to be a major issue for Taiwan, but also more globally. Nothing will escape if something significant happens in Taiwan, given it's at the very centre of the global semiconductor trade. The other thing we look at, though, is what are the benefits? Again, as things start to happen in Taiwan, who might do well? So, for example, Samsung as the only number 2 viable foundry really in the world today. Something happens to TSMC, then actually that is probably the major beneficiary, and you can make a lot of money out of having Samsung. So, from a portfolio perspective, it's about having, I suppose, a balanced portfolio, knowing the risks and what might do well or hedge against what happens in Taiwan.
Great, thanks. We've had another question in, how do you see the AI race developing in China?
Yeah, so China's artificial race is definitely developing differently from the West. If you look at the United States, the race has really been led by frontier models, and enormous spending on chips and data centers. Now China is more constrained on those advanced semiconductors because of sanctions. So it's had to really innovate around efficiency, cost, and deployment. And that's really why I think DeepSeek, mattered. It showed that China could produce highly capable models at a fraction of the assumed Western cost. Now, whether or not every claim is perfect, the signal was important. China is not out of the artificial race. In fact, it's very much in it. But I think the bigger point is probably deployment. China has huge consumer platforms, enormous engineering talent, deep manufacturing ecosystems, and a very practical approach actually to applying technology. So I think China's advantage may be less about building the single most powerful model in the world and more about rolling out AI into factories, cars, phones, robotics, logistics, consumer apps, just at massive scale. So ultimately, look, the West may lead in frontier AI. I think China may lead in applied AI.
Great. And another question's come in about your unlisted exposure. So how much of the portfolio is in private companies, and I know you spoke about ByteDance earlier, but are there any other examples you can talk us through?
Sure, yes, it's probably a sort of brief answer. I mean, the portfolio's got about just under 5% in unlisted at the moment, but the most significant chunk of that is ByteDance. That would be just under 4%. So the only other two sort of notable holdings would be Daily Hunt, which is a social media app in India. In many ways, the TikTok of India. Really benefited because TikTok was actually banned. Was banned from India. So our hope was that would be able to become the leading social media app in India. It's proved to be a bit more challenging. Competition has been much stronger, particularly from actually the Western brands like Instagram. And then the second one is Microconnect, which is a lending business based in China. But again, relatively small at about 0.5%.
Great. And another question's come in about your process. So what characteristics do you look for in a stock?
Sure. Look, so the key thing we're looking for are the best growth businesses in Asia. and ultimately we want to be able to double our money in any company we invest in over a 5-year time horizon. But we don't want that to come through just a re-rating, and we want that to come through earnings growth. So really, we just want a company at a minimum to be able to grow its earnings at, say, 15-20% per annum. However, I think what makes us perhaps a little bit different from other growth managers is that we do embrace growth in all of its forms. So we think there are 3 key growth inefficiencies that we invest in across the region. The first is duration. We're just talking about world-class companies where we let compounding do the work for us over many years. So the likes of TSMC that we've had in the portfolio for nearly 2 decades. The second is pace. And here we're really talking about rapidly growing businesses where the market misunderstands how quickly these businesses can scale. So the likes of Acton, which makes data center switches, we invested in that 3 or 4 years ago. We increased our position significantly back then. But that's because the market said this business can grow 15%. But we spoke a lot to our US colleagues, the likes of Google and Amazon, Acton's customers, and we actually thought this can grow 30 or 40% per annum. Turns out we're actually out by a factor of 2, and the shares are up 4 or 5-fold since our investment. And then the final inefficiency we like to call surprise, and here we're really talking about sudden changes or inflection points in industries where the market is very much anchored to today, but we're looking for what might change in the future. So we discussed copper earlier. Our view there is that at some point there's going to be an inflection point where the supply just can't keep up with demand, and actually earnings are going to look substantially different to what the market thinks today.
Great. And another question's come in about concentration. So there's been increased concentration in the MSCI Asia Pacific ex-Japan index. Is that a concern for you?
Yeah, I think it is becoming problematic. The top 5 holdings in the region would be more than 30% of the index today. And that does make it more difficult. Obviously, if you like those businesses and you want to have express an active position in those, you've got to have very large holdings, and that eats into your active share, which ultimately I think makes things a little bit more difficult when things get to those sort of levels. So yes, it is a headwind. Now at the moment we actually do tend to own in size some of those big large positions, the likes of Samsung, Hynix, TSMC, Tencent, and that's because actually in these businesses scale is one of the key competitive advantages. In semiconductors, it's all about having the most amount of capital to deploy and having the biggest, most efficient fabs. So the bigger you are, the bigger your advantage. In the internet platforms, the size of your ecosystem is your dominant advantage. So in many ways, although I say it's a disadvantage how large they get in the index, it's also a symptom of the big advantage they have in that scale really, really matters.
Great. And we have another index-related question. So Asia has had a has significantly contributed to growth, but is underrepresented in global indices. Do you see that kind of gap narrowing?
Yeah, I suppose it's one of the big anomalies of the past, 10, 15, plus years. Asia really matters. It's owned half the world's population. Probably accounts for about 1/3 of global GDP, 2/3 of global GDP growth. Yet it's less than 3 or 4% of global indices. So yeah, it is an anomaly, and I suppose that is the big advantage, or the big opportunity that it finally starts to catch up. I suppose the question is, why has it been so poor over the past 10 years, especially given what we've been talking about? I think a large part of that is, 2 factors. It's had these 2 big headwinds. The first has been China has been going through this very difficult period. As we mentioned, I think that is starting to bottom, and actually China is probably going from being the biggest drag to maybe the biggest catalyst for Asia. And then secondly, you've had this very difficult environment of a really strong US dollar and rising rates in the US. And that is always the most challenging environment you can have for the region. It sucks liquidity away and puts a lot of pressure. But if Asia can, hold its own in that environment, imagine what happens if that starts to reverse and it goes to a tailwind. So yes, I think I think it highlights the opportunity we've got if things really start to turn over the next 5 or 6 years.
Great. And the final question is, why would an investor consider going active if they want exposure to the Asia Pacific region versus passive?
Well, I think it's one area. Yeah. I think it's one area where you can actually add a huge amount of value as an active manager. If you look at Pacific Horizon over 1, 5, 10, 15 years, we would have massively beat the index, and particularly over the long-term numbers. So I think there's evidence that you can certainly add a lot more value in the region. Now, why is that? Well, look, I think you've got to be active because the opportunity set is incredibly uneven across the region. This is not an area where you can simply buy the index and get the growth story. The index gives you a lot of yesterday's winners, banks, state-owned companies, old exporters, and mature tech platforms. But the real excitement is often elsewhere. The next generation of semiconductor companies, EV supply chains, etc. The areas we've been talking about. I'd also say the macro matters a lot. There are often areas where you just want to avoid. So, for example, we've got very little invested in places like sort of the Philippines, Malaysia, etc. So there are times when you just don't want to be in areas because the macro looks poor. And also the index misses a lot of interesting stocks and countries. One of our largest overweights is still Vietnam, which is not in the index. And we've also got big holdings in Kazakhstan, where we think there are some fantastic opportunities, but again, not in the index.
Great. Well, thanks very much. That's all we have time for today. Thank you, Roderick, for your time and your insights. And thank you for those watching for your questions. We have more sessions like this coming up from Baillie Gifford, so do keep an eye out for those if you found today useful. Thank you and goodbye.